This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Hello, and welcome back to Understanding Money. In today's episode, we're uncovering one of the most powerful forces in finance, compound interest. By the end of this video, you'll understand exactly how reinvesting your earnings can turn even small contributions into substantial wealth over time, and you'll walk away with a clear step-by-step roadmap to harness its potential in your own portfolio. Ready to see your money work harder? Tap like, drop a comment with how many years you plan to invest, and hit subscribe to join our community of savvy investors. Okay, so let's begin by contrasting simple and compound interest. Simple interest pays you a fixed percentage only on your original principal. For instance, invest $1,000 at 5% simple interest and you earn $50 each year. And after 10 years, you end up with your original $1,000 plus $500 in total interest, or $1,500. Compound interest, however, pays you interest not only on your principal, but also on the interest that has already been credited. That means in year 2, you earn interest on $1,050 instead of only $1,000, boosting your earnings and growing your balance faster over time. To illustrate the exponential power of compounding, consider 3 hypothetical investors, each starting with $1,000 and earning 7% annual compound interest, roughly the historical inflation-adjusted return of the US stock market. Investor A starts at age 25 and makes no additional contributions. By age 65, their initial $1,000 grows to around $15,000. Investor B waits until age 35, then invests $1,000 with no further contributions. By age 65, that $1,000 transforms into approximately $7,500. Investor C starts at age 25 and adds $200 per month to their investment. By age 65, they'll have accumulated over $500,000. This comparison highlights 2 lessons. The earlier you begin, the more time compounding needs to work, and regular contributions amplify growth dramatically. Next, let's look at 3 practical scenarios. First, dividend reinvestment plans, or DRIPs. Many companies pay quarterly dividends. If you enroll in a DRIP, your dividends automatically purchase additional shares, including fractional shares, on the dividend payment date. For example, if you own 100 shares of a utility stock paying 4% annual dividends, you receive $400 per year. Reinvested quarterly, those dividends compound immediately by buying more shares, boosting your future dividend payments. Second, comparing high-yield savings accounts with index funds. Suppose you have $5,000 to invest. Placing it in a high-yield savings account at 4% annual percentage yield grows to about $7,400 after 10 years. Investing the same amount in a total stock market index fund, averaging 7% annual returns, grows thoroughly $9,800 over 10 years. The extra growth comes from higher expected returns and the power of compounding over time. The trade-off is volatility. Savings accounts offer stability, while stocks fluctuate but deliver higher long-term returns. Third, retirement accounts and tax advantages. Tax-advantaged accounts like Roth IRAs or 401ks allow your investments to grow tax-free or tax-deferred. If you open a Roth IRA at age 25, contribute $6,500 each year for 10 years, and earn 7% annually, by age 65, you'll have over $1 million, despite only contributing $65,000. That $1 million is largely compound interest and underscores how tax benefits supercharge compounding. Now let's focus on how to implement compound interest strategies step by step. Step 1. Start immediately, even if small. Open a brokerage or retirement account today and invest whatever you can, $50 or $100. The sooner you begin, the more compounding periods you'll enjoy. Step 2. Automate dividend reinvestment. Enable DRIPs for any dividend-paying stocks or ETFs you hold. Check your brokerage settings to ensure dividends purchase additional shares automatically. Step 3. Schedule recurring contributions. Set up an automatic transfer of a fixed amount from your checking account to your investment account each month. Even $20 per month adds up. At 7% average returns, $20 monthly grows to over $100,000 in 30 years. Step 4. Use tax-efficient accounts. Max out contributions to employer-sponsored plans or IRAs first to harness tax deferral or tax-free growth. This keeps more money compounding without annual tax interruptions. Step 5. Minimize fees and expenses. High expense ratios and transaction fees erode your compounding base. Choose low-cost index funds or ETFs with expense ratios below 0.10%. If you trade frequently, consider commission-free brokers or focus on buy-and-hold strategies to limit trading costs. Step 6. Monitor and adjust annually. Once a year, review your portfolio's performance, rebalance back to your target allocation, and verify that your automated contributions and DRIPs are still active. Before we conclude, let's address common questions. Does compounding work in bear markets? Yes, it works on any positive returns. If your investments decline temporarily, compounding resumes once prices recover and dividends are paid. Staying invested through downturns ensures compounding continues uninterrupted. How much do I need to start? No minimum. Many brokerages now allow you to start with $1 via fractional shares. The critical factor is consistency, not the initial amount. Can I compound with cryptocurrencies? Some crypto platforms offer staking or lending to earn yields. While possible, these rates and risks differ from traditional assets. Before including cryptocurrency in your compounding strategy, take the time to thoroughly research each platform's security protocols, such as encryption standards, insurance coverage, and custody solutions. Carefully review any lockup or staking periods that may restrict your access to funds, and stay up to date on evolving regulatory requirements and compliance measures to protect your capital and ensure you're operating within legal frameworks. And a final compliance reminder: I'm not a licensed financial advisor. This content is for general education only. Consult a qualified professional to tailor these strategies to your personal situation. Compound interest has been called the eighth wonder of the world for a reason. It transforms time from something that just passes by into your most powerful ally, allowing even modest investments to grow exponentially when given enough patience and consistency. And cultivating this disciplined approach to saving and reinvesting can become a valuable habit that benefits all areas of your financial life and beyond. Begin your journey today. Maintain unwavering consistency in your contributions and reinvestments, and watch as your disciplined approach empowers your money to steadily grow and work for you across the decades to come. If you found this deep dive illuminating, please tap the like button, share your compounding ambitions in the comments, and subscribe to Understanding Money for more actionable financial insights. Share the video with a friend. It really helps the channel to grow and to reach more people just like you. Please let me know if there is anything you would like me to cover in future videos. Thanks for watching, and I'll see you next time.